Welcome back to the portfolio, everyone. Today we're going over the top 5 stocks I plan to buy this week. These 5 companies are at the top of my watch list. They're a combination of dividend and growth stocks, and these stocks I plan to add to my existing positions or start new positions in these companies this week. These 5 companies are solid blue chip dividend paying companies that will continue to grow their dividend year over year. As well, there's some growth companies that I believe have strong fundamentals to continue to grow their share price long into the future. So as always, I am the Gen Z investor, and every single day I come up with new videos that talk about different stocks you can buy, the overall stock market performance, as well as any big stock market news and headlines. So we're going to jump right into it. I please ask, can you like and subscribe? And we're going to jump in to pick number 1. The first pick I plan on adding to my portfolio this week is ticker symbol INTC, Intel. Currently trading at $59 a share. You can see here on the 1-year price chart, they are up 22%. They have not fully recovered to pre-pandemic levels, which may make this a nice buying opportunity. Large market cap at $250 billion with a nice 2.23 current dividend yield. As you can see here on the 52-week green, they are in the middle. So a lot of room and a lot of upside potential with Intel for share price. If we take a quick look at their fundamentals, they've done everything we expect and everything we want to see from a strong growing company. Have a nice growing revenue year over year. So 5 years ago, their revenue was around $55 billion. Trailing 12 months revenue all the way up to $75 billion. Gross profit has followed the similar trend. And if we take a look down here at net income, you can see net income has a nice, beautiful, long upward trend year over year, which is great to see. With regard to their balance sheet, they are in a strong financial position right now. Total cash and short-term investments of over $20 billion. Total current assets at over $41.5 billion. Meanwhile, the total current liabilities sits just around $24 billion. So a current ratio close to 2. They have a lot of current assets to cover all their current liabilities and continue to operate very strongly. They actually have almost enough cash on hand to pay off all their liabilities, which shows the company has a very strong balance sheet and is going to have no issues in the short term. The dividend, of course, as dividend growth investors, we love having companies that pay a nice consistent dividend that continues to grow year over year. So a nice yield at 2.23%, a little bit on the low side, but nothing too minimal. Very low, very sustainable payout ratio at close to 28%. This company has a lot of leftover room to grow that dividend year over year and a lot of leftover money to stay within the business in order to grow operations, to continue to research, develop, and innovate so they can generate more revenue moving forward. So I believe Intel is going to have a great job and do a great job of growing this dividend years into the future. 5-year dividend growth rate at around 7%. Nothing too minimal, but nothing too high. Nothing drastic, but it's great to see that dividend growth rate faster than the rate of inflation with a 6-year dividend growth history. The dividend is considered very safe from Simply Safe Dividends with a ranking of 96, showing that this is a very volatile stock with a beta around 1.24. So if you could handle some price fluctuations, this may be a company you want to add to your portfolio right now. And they do have a strong future coming up with the integration of 5G into our everyday lives. Intel is going to have some nice revenue growth moving forward. The second stock on the list this week is, of course, Warren Buffett's golden eggshell, Berkshire Hathaway, ticker symbol BRK.B. So these are the Class B shares, currently trading at $178 a share. So Warren Buffett, of course, is known for owning dividend-paying stocks and collecting dividends year over year from companies that continue to increase those dividends every year. But his company does actually not pay out a dividend. So this is a growth play. There is no dividend coming out of Berkshire Hathaway. On the 1-year chart, you can still see it is down. It's over 16%, which is what is really appealing to me. I do believe there's a lot of upside potential with Berkshire, only because they have not fully recovered to the pre-pandemic levels. Take a look at their 52-week range. They are trading on the low side, which is good to see because I do believe in this company long term, and I do believe they have the fundamentals. And essentially, when you're buying this company, you are buying an ETF because this company is so well diversified into so many different market segments. They have such large positions in some of the biggest companies in the world, and of course, they wholly own a lot of other brands throughout America and some European countries. You can see here on the 5-year chart, they are up over 30%. And if we take a look at the 10-year chart, they are up 131%. So they do have that price growing year over year. Of course, on the 1-year chart, because of the pandemic, they have declined, but they have not recovered yet, which might make this a nice buying opportunity. Very large market cap at $434 billion, making this one of the most valuable companies in the world. If we take a look at what they own, so these are the companies they own 100% of. So you can actually understand some of these names. You'll remember them. Geico, Fruit of Loom, Duracell, Dairy Queen, Benjamin Moore. Berkshire Hathaway owns 100% of these companies, and a lot of these companies are household names. If we take a companies they own large shares of and large chunks of those companies, again, a lot of financial companies, a lot of consumer brands. You can see Apple is their largest holding. They have a lot of financial companies, US Bank, Bank of America, Wells Fargo, American Express. Of course, Coca-Cola, very famously for owning about 10% of Coca-Cola stock. He did sell out of his airline stock, so those are no longer owned in his portfolio. Of course, Goldman Sachs, he reduced his position. So there's a lot of these massive companies that he owns significant stakes of. Now, what draws me the most to Berkshire Hathaway is their financial statements. If we take a look at the income statement, they are generating huge amounts of revenue. If we look at their total revenue line, over the past 5 years, each and every year they've grown revenue, and every year they grow revenue by a significant amount. 5 years ago, their revenue was over $200 billion. Trailing 12 months, their revenue is over $256 billion. So they've done a very nice job of growing revenue year over year. And of course, we got to take a look at their net income. Net income is a little bit of fluctuations, which is okay because this company is an ETF. They own so many different brands and different companies in their company as their holdings. I believe this company is going to continue to grow net income just fine. And because they don't really pay a dividend, you don't really have to worry about their net income slipping year over year. You can see here that they have growing net income, one-off year, fully recovered back up $81 billion in net income, followed by the trailing 12 months of a little bit of a decline, but nothing too worrying for Berkshire Hathaway. And why I'm not too worried is this spectacular balance sheet that they have. Berkshire Hathaway and Warren Buffett are cash cows. He loves investing in businesses that cash flow, and of course, their financial statements and their balance sheet shows that. If you take a look at their 2015 financial statement here, you can see their total cash and short-term investments are around $64 billion. 5 years later, their trailing 12 months, their total cash and investment holdings in the short term at over $137 billion. So they've doubled their cash position from $64 billion up to over $137 billion in a matter of 5 years. This company has done an extremely good job of generating cash. They have so much buying potential that they can buy out so many of these large companies throughout the S&P 500. And I really believe Warren Buffett's going to make some moves. He's been holding this cash for a long time, as you can see. Over the past 5 years, he hasn't really done any significant buys. People were shocked when he didn't make any buys during the pandemic lows. But for whatever reason, Warren Buffett is the greatest investor all the time. If he's holding out, there is something he is waiting for. He hasn't found a good deal yet, or whatever he's trying to add to his portfolio, he hasn't gotten there yet. But when he does, I believe it's going to show huge potential for Berkshire when he announces and when he buys any different company throughout the S&P. And of course, with their total current assets at over $196 billion. Meanwhile, their total current liabilities are only around $100 billion. So they have more current assets and more cash on hand to actually pay off all these liabilities and continue to operate very nicely into the future. The third stock on the list I have at the top of my watch list this week is Merck & Co., ticker symbol MRK, currently trading at $78 a share. You can see here a very large market cap, once again at close to $200 billion. This company is a nice dividend-paying company with a 3.1% dividend yield. 1 year price chart, you see they are down around 8%, and on the 52-week range, which are trading right in the middle, which again, this is another reason why they are at the top of my watch list. I do believe this is a nice entry point for the company within my portfolio. Take a look at the 5-year chart, you can see they are up over 36%, and on the 10-year chart, similar to Berkshire Hathaway, they are up over 130% overall. In regard to their financials, another strong company, you can see total revenues growing year over year, which is great to see. Then if we take a look at their net income, it follows a similar trend. Each and every year, we see a nice upward trend in net income. In the trailing 12 months, they've generated over $10 billion of net income. With regard to their balance sheet, they have total current assets at around $26 billion. Meanwhile, total current liabilities at around $23.4 billion. So the current ratio still is above 1. Not as nice. We like seeing those current ratios around 1.5 or 2. So Merck should try to get that up as soon as possible. But of course, they have enough assets on hand to cover those liabilities without any issue. This is a dividend-paying stock, and of course, we love that dividend income coming into our portfolio. See a beautiful starting yield at around 3.1%, which is a nice average yield to get into. Very safe, very sustainable, 46% payout ratio, giving this company a lot of room to continue to grow that dividend year over year. 5% dividend growth rate over the past 5 years, so a little bit slower of a dividend growth rate, nothing too exciting there, but at least your dividend is growing at a rate faster than inflation. And of course, with the sector this company's in, it's to be expected. With 5-year dividend growth rate around 5%, that's somewhat normal. with a 9-year dividend growth streak. Shows this company does have a good history of growing their dividend. I do like having companies that do grow their dividends for at least 10 years before I add them to their portfolio, but of course 9 years is not going to stop me. With regard to dividend safety, they have the highest dividend safety rating. For a healthcare company, that is great to see. You can see a 99 very safe dividend score. With the low beta, the stock price is not as volatile as the overall market, which is nice to have a little mix of low volatile stocks within the portfolio. And of course, you did see the 5-year average dividend growth rate around 5%, but last year they did grow their dividend 11%, meaning that they are showing the upward trend in dividend growth. Hopefully they continue that nice upward trend moving forward. The fourth stock on our list this week is Verizon, ticker symbol VZ. So currently trading at $54.79 a share. Of course, this is a telecommunication company, another large market cap at over $226 billion. 1-year price chart, they are down over 6%. If we take a look at the 5-year chart, they are up 16%. And on the 10-year chart, they are up around over 105%. Once again, trading in the middle of their 52-week range, which is what made this very attractive to me right now. I do see a lot of upside potential with Verizon, especially with the new integration into 5G. I actually made a video about 5G yesterday and all the different stocks that are going to benefit. And Verizon is a company that was not included in that video, but will actually benefit very nicely from 5G. They do pay a very nice, very high 4.5% dividend right now. With regard to their financials, you can see they've done a beautiful job of growing revenue year over year. We see a nice upward trend in revenue. Meanwhile, gross net income has done the similar trend, upward trend here. We did see a very outlier year right here of net income of over 30 billion, but has returned to the normal upward trend, which is great to see. With regard to the balance sheet, they have total current assets at over $40 billion right now. Meanwhile, their total current liabilities are at $41 billion. So not the best balance sheet. We do like having companies who have total current assets over their total current liabilities, just to show that in the next 12 months, they're going to have no issues whatsoever paying off that debt. So they are very close. Their current ratio is at around a 0.96 right now, 0.97. So they are very close to having that current ratio at 1. Only $1 billion less of total assets compared to total current liabilities. But of course, they can get that up over the long term. And I do believe the company will get it up to maybe a safer around 1.5 range, which makes it a little bit safer moving forward. And I'll be happy when I see that happen. With regard to their dividend, a 4.5% starting yield right now if I were to start a position. Very sustainable 52% payout ratio. So a lot of money and left over for the company, as well as a lot of room to grow that dividend into the future. Very, very slow 5-year dividend growth rate at only 2.5%. That is the one drawback when investing in companies like this. Of course, INTC has a higher starting yield, but they have a very similar 5-year dividend growth rate around 2 to 3%. So these two companies, I had to go between the two, and I actually went with Verizon only because I see a little bit more of upside potential with regard to 5G and how it's going to integrate within their company. Total dividend growth years streak at around 13 years. And with regard to that dividend safety, they are at an 87. So the dividend is considered very safe, with an extremely low beta of only 0.54. The fifth and final list on this stock list is Starbucks, ticker symbol SBUX, currently trading just under $74 a share. 1-year chart, they are down 13.7%. So you can see here they have not recovered from their pre-pandemic levels once again, which is why they're at the top of my watch list, and it seemed to be another great buying opportunity. On the 52-week range, you can see a low of $50 with a high around $100. So they are currently just in the middle of that 52-week range. $86 billion market cap with a nice starting yield around 2.22%. With regard to company fundamentals and financials, you can see they've done a beautiful job of growing revenue year over year. With regard to net income, a little bit of an upward trend. You see net income, 5 years go around 2.7 billion up to 3.3 billion. Upward trend year over year, which is nice to see. Balance sheet, not the strongest balance sheet, but nothing too crazy. You see total current assets at around 5.7 billion. Meanwhile, total current liabilities at 8.3 billion. So a lot more current liabilities than current assets. They really need to improve their current assets position right now in order to reduce those current liabilities. They really need to bulk up some cash right now in order to pay down that debt, so the next 12 months they can sustainably grow their business. With regard to the dividend, they have a 2.2% starting yield. This payout ratio shows 215%, which would be extremely high, and I would personally not invest in a company like this. But this payout ratio is actually incorrect. If we take a look at another website, you can see here for the trailing 12 months of earnings, they're paying around 58%. On next year's estimates, they're around 62%. Based on cash flow, they're around 40%. based on this year's estimates, puts them at over 205%. But of course, with the economic shutdown and closing down stores, that's what's kind of skewed those numbers. With the other ratios, you can see a much more sustainable dividend payout ratio. Going back to it, you can see a huge 5-year dividend growth rate at around 22%, with a 10-year dividend growth history showing this company can consistently grow its dividend nicely over the past 10 years. And the dividend. So of course, this company is a little bit of a riskier play, a little bit of consumer play. Why I'm adding it to the top of my watch list is because once the economy fully reopens, and of course people hopefully would be a little bit safer with their money, and Starbucks is more of a premium priced store, I still believe the company is going to continue to grow and at least go back to the pre-pandemic levels, which shows a nice 30% upside in the stock. So I am not too worried about that. With a dividend safety score around 67, is safe, but not the safest. All the other companies we saw today that paid a dividend were at very safe dividend with a very nice 13% dividend growth last year. So those were the top 5 stocks I had at the top of my watch list right now. These companies I plan on adding to my portfolio this week. Some are dividend paying stocks, some are growth stocks, but I believe they have strong fundamentals and will continue to grow into the future. So every single day I come with new videos that talk about different stocks you can buy, the overall stock market, and a bunch of different other headlines within the market. So please like and subscribe, and I will see you in the next one.